Top three things this morning: U.S. dollar, number one; number two, the 10-year bond yield in the U.S., and number three, commodities via the CRB 19-component commodities index. Point number one on the U.S. dollar, not surprisingly, into and out of the Janet Yellen central planning event, which was very dovish, the dollar has weakened. Again, it weakened at a very important point because, of course, the trend line of resistance at Hedgeye on the U.S. dollar index is 81.39. So it failed at the trend line, and embedded therein is this rally in the euro. So even though the Europeans are cutting interest rates, that has still been bullish for the last, call it, 5 trading days for the euro, which shouldn't be a surprise because the Fed on the margin is getting more dovish. Point number two on the 10-year bond yield, this, of course, has flowed through to the 10-year bond yield, which, of course, failed at 2.81 resistance, which is its immediate-term trade resistance line. Important line now to test here on the 10-year bond yield is 2.63%, which is the trend line of support. So, again, the Fed wants the bond market to basically arrest its decline, and the reality is that that may not be in the cards from a longer-term perspective. We're spending a lot of time on the road with clients talking this through. Again, I do fundamentally believe that the Fed will lose control of the bond market within the next 6, 12, 18 months, whenever that may be. It might be within the next 6 hours. The point is that it's a nonlinear reality that they've basically anchored into the market here with a wicked amount of asymmetry. So again, if the 10-year bond yield holds 2.63%, you're darn right I'm going to be shorting treasuries again, so watch out for that. And then finally, commodities have just been an abyss, really, from an asset allocation perspective. As you know, throughout the year, for the better part of the year, with the exception of a couple trading days where we've been long gold, which we're not anymore, we've been 0% asset allocation to commodities. Now, commodities, the CRB index is what I'm talking about here. It hit a fresh year-to-date low yesterday at 272, which is down almost 8% for the year-to-date. Now, that's good for consumers. That's a tax cut. But unfortunately, the Keynesian central planners don't understand that. They think that that's deflation versus the all-time commodity prices highs, which they, of course, perpetuated throughout 2011 and 2012. So watch this one. Again, commodities not where we want to be hunting for long ideas, certainly not right here now, probably not into year-end either. We might get a signal on gold to buy it back sub 1260, but again, you're going to have to wait for the real-time alert on that. And those are your top three things.